Our next panel is the highlight of the show, because it's usually the one I have. Our moderator, do I need to introduce our, not moderator? Now, Justin, I don't know how to spell this guy's name. Zimmerhansel's easy, but it's I don't get him. Roy, the panel is yours.
Thanks very much, Gabriel, for that interesting introduction. In fact, the problem with transparency when I started was that was before light. So as you say, this is the panel. You know, trading and liquidity is at the heart of the business. Securities finance goes from market making to keeping investors and traders going through to the support for short sellers, be that hedging, arbitrage, or directional trading, or for collateral transformation and actually keep things moving from a regulatory or an optimization perspective. So indeed, as you say, this is the most important panel of the day, with all due respect to other panels and panelists. Fortunately, we've got a group of panelists today that actually will be able to meet up to the high standard that's expected and required. So I'm really pleased to introduce him. By the way, I'm Roy Zimmerhansel. I'm from Pierpoint Financial, where we do consulting in all aspects of securities finance and collateral management. And so I will now ask my panelists to introduce themselves. And first, we'll start with Travis.
Hi, good afternoon. Good morning, everyone. Yes, I'm Travis Keltner. I am the head of repo trading and our financing solutions and collateral optimization products at State Street. So thanks, Roy, and really happy to be here today.
Great. Thanks very much, Travis. Shane, over to you.
Yes, good afternoon, everybody. Roy, thank you for chairing this panel session. My name is Shane Martin. I'm in charge of securities finance sales at WeMatch. And a big thank you to Justin and the team at Securities Finance Times for hosting this event and inviting me to speak today.
Thanks, Shane. Mike, over to you.
Thanks, Roy. Hi, guys. I'm Mike Norwood. I am the product owner for Equilen's global suite of trading products. That includes NGT, our clearing platform, and our swaps platform.
Thanks, Mike. And so far, you win the prize for the best voice on video so far. Ed, if we could turn to you now, please.
Hi, I'm Ed Tyndall-Biscoe. I'm the product owner at Ion Markets for our secured funding group. So as a group, we provide software for workflow, automation, trading analytics, business information across capital markets. In the secured funding space, we provide order management, collateral, inventory management, and trade processing across repo and security lending.
Great. Thanks very much, Ed. And so for the next 3 hours, these panelists will be exploring various elements of trading and liquidity. We might have to cut it off after an hour, but what I encourage you all to do is to send in your questions throughout. Don't save them up till the end. Let's try and engage these people into a good conversation. Put out challenging questions. They're well suited to actually respond to them. So I think what I want to do is actually sort of set a perspective. And if we go back to kind of what Sarah was talking about, you know, the reality is we are talking about a time continuum and the transformation over time. One of the interesting things for me is how we've gone from distinct business lines into a securities finance universe. So I'm wondering, maybe Shane, since you've seen a lot of this, you know, are the lines sort of completely blurred between the different transaction types, securities lending, repo, synthetics? What are your thoughts and what have you seen on this?
Sure. Thanks, Roy, and a good start in relation to the questions. For those of you that don't know me, I have spent many years on the equity finance desks at my previous firms, but I had the absolute pleasure of, when I first started in the industry, working for Mr. Zimmerhansel back in the day. We won't say that there was, how many years ago it was, but it was a fair few years back. And the reason why I reference that is that when I first started in the industry, when we had a short to cover the natural way to do that was to go into the securities lending market and borrow the stock. And over the last, say, decade, there's probably 2 decades, if the truth be told, the evolution of the business has completely changed. It's on the last panel session, obviously, which we just caught the end of, Fabian and Ed and Gary were talking about regulation and the footprint that's had on the industry. And I think within the securities finance space, that regulation that's happened since 2008 has fundamentally changed the equity finance, securities finance business. There's 2 main reasons for that, in my opinion. One is spread compression. When I first started in the industry, spreads were quite wide, and as time has evolved, those spreads have continued to evaporate. So the need to find different ways to trade liquidity, find liquidity, and enhance market participation is really required. And from my perspective, the lines between synthetic, repo, and traditional securities lending have and will continue to blur in the future state. And the reason for that is, as I said, spread compression is one, but the main driver has really been the regulatory changes that have happened. The impact on the business certainly surrounding NSF4, LCR, RWA, GSIP. Each individual firm has a different set of criteria that they need to opine to. And that means that they're looking at the way that they're diversifying their books, right? Evergreens, extendables became a theme in securities lending because people were looking at their weighted average maturity of their portfolio. The exact same in synthetics. And from that perspective, that's meant that when people are looking at their book, they're looking at holistically, they're solving the different criteria that each of those individual firms are addressing. And they're definitely going to the market looking at the TRS market. If I look at WeMatch as an example, the incremental growth that we've seen in the synthetic business over the last 24 months has been astronomical on a global basis. Our volume and balances have dramatically increased. And that's because we're seeing more participants coming to the synthetic market to cover short activity. They're buying naturals rather than going to the market to borrow stock because it's cheaper. They're able to find more diversification. They're able to address their non-derivative trading asset, their NDTA on their balance sheet footprint on the basis of trading synthetics. And if I look at the prime brokers today, they're coming to WeMatch to trade synthetics. They're coming to WeMatch to trade securities lending. And we also, because we have an equity derivatives product, they're coming to look at transparency of data around what's in the TRF market. So being a unique vendor / fintech company in the space where you can trade synthetics, TRF, BTRF, and securities lending, we are uniquely placed to see the transformation of the market and where, Roy, as your original question asked, the lines between all 3 components, in my opinion, continue to blur. And maybe I'll hand that over to maybe, Ed, I don't know if you've got an opinion on that in relation to, or Travis or the rest of the guys on those thoughts.
I can maybe talk about it from a technology point of view. I mean, as you said, the blurring has definitely happened. How fully complete that blur is really, I think, depends on who you talk to and where they are in the business. To me, it's kind of still a bit cyclical, although it's definitely in that direction of travel. The full consolidation of the business lines for a lot of the reasons that you said. Without going into the history, technology-wise, you had these big platforms that originated. They were designed to do very specific things, and they were very siloed. I think Fabian talked at the end of the previous panel about the level of fragmentation that still exists in that landscape. But as maybe the technology budgets start to consolidate, you have shoehorning of different flows into systems that aren't really designed to be flexible enough to deal with the nuances of those particular flows. And these days, with the design of new modern systems, they're much better able intrinsically to handle that flexibility. And they've been built specifically with that in mind. So a key part of being able to really consolidate that is how the data is managed and made accessible to report on, consolidating data lakes, having tools that are designed and built from the ground up to manage that really helps and is a big enabler of blurring of that flow. There's a lot of kind of discussion in various conferences and panels about the common domain models. So the merging of the ISDA model, the ISLA model, the ICMA model, all consolidating that into a single unified thing. I think that's going to really contribute to the continued convergence of the different business areas. I think in our client base, we still see quite a bit of a mix in terms of approach and strategy. So there's kind of an ebb and flow as to how fully joined up they are from top to bottom. But as I said, the general direction, I think you said, is collateral trading, whether that's repo, securities lending, secured funding, equities, fixed income, synthetics. It's really one business area. And in a world where, central bank liquidity, is becoming less supported, the market rates, more uncertainty, how you optimize the full set of your collateral, really being able to understand all the different implications of that. That's a super important driver for how that will continue to merge, I think.
Yeah, thanks for that, Ed. And look, I'll take a step back even from where Shane started, because Shane sort of started with the firms, and Ed, you've kind of carried it on to the technology supporting those firms. Of course, the real beginning for all of this was end customers wanting more cost-effective solutions and not having to have multiple people servicing them. Travis, do you have anything to add to that?
Yeah, just on your last point, when you say customers, and I think kind of speaking from a markets and a custody bank perspective that services one of the largest group of buy-side clients out there, what you start to see kind of from the bottoms up, the custody up to the market trading, is you see, right, you do see technology, some of the points just made, technology and accessibility to markets, really blurring that difference to really making it collateral trading, not a specific type of product. So that obviously leads to spread compression to the point earlier, and the technology addresses it. But then you think about the buy side kind of sophisticating to centralized treasury functions where they look at everything holistically. And we hear a lot more around this theme of what we like to call convergence of different types of asset classes. Is how do you best manage your collateral? If you're custody with us, if it's someone else, how do you bring those positions together? How do you then look at that in without too much latency, and then manage your decision making on how you route those positions from that kind of collateral trading view? So it's not a sec lending desk. It's not a repo desk. It's really a centralized view, and whether that's on the desk or in the treasury function, that's the theme that's really blurring the lines that we see from our perspective.
I think just to add to that, sorry, Mike, just before we jump in, I think to add to that point, I think what we're seeing certainly at WeMatch is some of those underlying beneficial owners or buy-side clients that you mentioned, Travis, are actually coming to us proactively to understand and discover what's going in to our certainly technology from a fintech perspective in evolving the marketplace to that transition that you eloquently mentioned. So it's interesting to hear you're hearing the same feedback from your clients. Sorry, Mike, to jump in there.
Yeah, no worries.
That's great to hear it.
Yeah, I mean, I sort of agree with Travis. There's, I think, and all of you, frankly, is the lines are certainly blurring. Things are converging. I think the challenge that people need to face now is how do you maintain that holistic view of inventory? How do you best utilize that inventory? How do you take, make efficient decisions, optimize your returns, reduce your costs? Like, I think that becomes a really big challenge because as Ed mentioned earlier, things are siloed, right? So whether they're siloed from a technology provider perspective or from an internal, books, records, core processing engine perspective, sometimes they are different groups, different desks. They're making similar decisions for similar reasons. But joining that up, integrating that, making sure that people are taking that full picture view of what's going on and making the best informed decision that they can becomes the challenge off the back of it.
Yeah, and I think just sorry, Roy, to jump in, but I think, Mike, you make a really interesting point there about optimization and effectiveness and efficiency. And I think certainly from a market practitioner perspective, I think that lack of inefficiency of bifurcation of systems, technology at certainly the large firms, having to move technology, it's like moving an oil tanker, right? And I think where the likes of us and others in the fintech space, we add agility, we add innovation, we add flexibility to allow those behemoths of businesses to integrate, become more effective, be more efficient. And certainly from an optimization perspective at WeMatch, that's really been the game changer for us as a business, has been able to optimize optimize our clients' collateral liquidity in the TRS space, specifically allowing customers to not have any inefficiencies on the book, and therefore making the ROA and the ROE of those businesses so transparent and so effective and so efficient. And that's really the driving force here. Back to my earlier point on spread compression, regulation, balance sheet management. Sorry, Roy, to interrupt.
No, I mean, because I think that's the key point here. Because one of the challenges that I've sort of thrown out there for the past few years is that, you know, I've heard that securities lending is over supplied, right? And I keep trying to turn the conversation around the other direction and say it's not really oversupplied. It just costs too much to actually do that trade execution. So Shane, you guys have kind of talked about the optimization and trying to find whether that's for regulatory reasons or execution or whatever the driver is. And Ed was talking about the actual execution of that. Travis talking about the sort of the customer side of that kind of driving it or the need for that. But Mike, look, the reality of this stuff is the actual trade itself is kind of a nanosecond. It is a blip in time. And the reality is all of the costs pretty much go into everything that happens after that. So what are the challenges about sort of lowering the overall cost of trading?
And I think that's the point directly, right? Is I think people get hung up on transaction costs. Certainly transaction costs can be high. It's strange to sit here as a technology provider and say, we want to reduce the cost of trade while we're charging a fee for our service. But at the same time, it is about reducing the cost of trade. Everything that we're doing is about reducing the cost of trade. If you look at the industry overall, if you factor in, the spread compression that we mentioned previously, if you look at the increased regulatory cost of doing business in the securities finance space, whether it's reporting, whether it's capital related, whether it's penalty driven based on settlement efficiency like CSTR, ultimately whether it gets to settlement cycle tightening and we look towards T+1, right? The oversight cost of all of that from a middle office perspective, from an operational perspective, becomes increasingly daunting, right? So if you're interested in setting up a new securities finance business, right, that can be problematic to look and try to overcome. Right? You have to throw bodies at it. You have to throw technology at it. You have to factor all of that in when you're making a decision about how you're going to move forward. From a fintech perspective, we're looking at how do we make that more efficient? How do we optimize that? How do we remove friction? How do we give you the information that you require to make better decisions and then enable your human capital to spend time on the value add activities? Right. So from my view anyway, I think it's the strategic deployment of technology as a complement to personnel that increases scale, reduces cost because it removes some of those inefficient friction points. Right. If you start to look at connection to clearing services, right, you get sort of capital relief. You can have RWA reductions. You can have operational efficiency off the back of that. If you talk about straight through processing, right, as you said, trading, the actual execution of a trade is a point in time, right? Gone are the days when you want a trader sitting there banging out as many GC tickets as they can over the course of a day, right? That's something that is low margin business. It's ripe for automation. It's something that technology is really well placed to handle. But as you start to look towards the future and how do you complement humans and sort of not replace humans, you start to talk about, well, how do you identify what technology should be automating, what technology should not be automating, right? There is always going to be a place for human oversight, but human oversight is costly, right? So it's all about presenting the right information. I think we mentioned kind of managing data and making sure that it's stored in a way that it's accessible and it's easy to respond to changes, whether they be regulatory, whether they be efficiency based. I think what we're seeing now too is your efficiency and your operational processes make you more attractive as a counterpart, right? As we're having conversations with connecting new counterparties together, they're pushing back and saying, well, what are their practices around contract compare? Are they reconciling automatically? Are they using post office automation processes? What's their regulatory reporting solutions? And so more and more you're seeing traders on the front end concerned about processes on the back end where, 15 years ago, not even entering into the conversation, right? That overall cost, the cost of operational risk, the cost of regulatory plus the cost of the actual transaction itself is now kind of a blended hurdle rate that you've got to overcome if you're going to make the proper decision about how best to optimize your inventory.
Yeah, thanks for that, Mike. I am going to come back and challenge some of those things because I don't believe that there has been enough challenging of counterparties' delivery mechanisms and post-trade execution in terms of driving business in other directions. So I'm going to let you stew on that for a little bit. Travis, any thoughts on sort of lowering the overall cost of trading and so what that actually means?
I mean, Mike said it really well. I think, if you want to execute a trade, you think about these things. You may need a research platform. You may need a communication platform. You may need a broker. You likely need an EMS, OMS. You need an operations group. Perhaps you need a tri-party agent. Then you have to do reg reporting, SFTR, market data. These could all be different providers, vendors, et cetera. That all adds up to the cost of executing that trade. And so how do you improve that, right? Well, it's in each domain, you go the best in breed, you optimize, or you minimize the number of providers who can then provide, those fewer providers can provide scale. And so, you think those are the ways we like to think about it, because it gets really expensive. And the biggest thing we don't think about is and they're there for a reason, but the intermediaries. So, we talk about, we may talk about peer-to-peer later and some of these other things, but the balance sheet cost is the biggest cost that is baked into the price of a trade. And so all these things add up. And, whether you're positive rates or negative rates, if you think about that from a front office perspective, negative rates is cost, but you're thinking about cost as a trader in a negative rate environment, but then you don't think about it when you get to full TCA and everything under the trade, under the line. And so you got to think about that holistically when you do your analysis. So we're encouraging folks to think about that full cost, and going back to the siloed mentality, you just think about, well, what's the alpha on my return? Well, there's a lot more to it than just that. You really need to think through the workflow.
Yeah, look, and I agree with all that. I'm also, I'd be interested in hearing from the audience whether they have any sort of questions following up on this kind of area of choosing your counterparties based on their post-trade efficiency or their trade execution efficiency from beginning to end. Do you guys have any questions on that? Do you think that this is going as far and as fast as it might do? Ed, let me turn to you on the same kind of topic. Any thoughts there?
Yeah, I mean, I agree. But everything that Travis just said about the multiple teams, the multiple systems, the different actors that are involved in the end-to-end process. But maybe from my, where I sit as a vendor or as a technology provider, I think one of the historical barriers has been to entry to enable new participants is kind of the infrastructure costs, whether that's the setup costs to build your own solution or to buy something in, to deploy, to operate that in a production environment. Those are, pretty big outlays. Tend to be big, complex platforms that require quite a serious investment to get involved in. And the need for a kind of a flexible, accurate, reliable, scalable solution, that hasn't changed. It's always been there, but the cost of accessing that is fundamentally changing. It's dropping, but the pace of change is accelerating. So adoption of cloud, the widespread use of flexibility around compute power, simplified workflows or simplifying integration, all of those are changing, and I think reducing the barrier to entry for participants across the different sectors.
I would I'd jump in there as well, Ed. I think I 100% agree. I think it's very important to understand that the business and industry has had specific architecture for a long time, and I think that evolution of the business in relation to what we've been discussing for the last 30 minutes is requiring innovation and new entrants to the marketplace, and I think that is I would slightly disagree with you around the cost and barriers to entry. You're using WeMatch as an example. We launched 5 years ago, and in the last 5 years, that certainly from a TRS perspective, and as we engage in securities lending now, the traction that we've had has been phenomenal. And that's down to two things. One, you mentioned the cloud. One is that we have a very simple web-based GUI that people can access relatively simplistically. Yes, you're correct that getting into the architecture and workflow of those individual firms is definitely challenging. But if you are bringing something that's competitive, driving effectiveness, driving increased liquidity, time and speed, which is what the industry is crying out for, I think that the ability for people to come to market either under the CDM, as you mentioned earlier, or in new innovation, I think is really important. And I think the barriers to entry, although from an architecture perspective, I agree, but in relation to getting access to platforms like ours, it's relatively straightforward.
I'd agree that I think we all are trying to do a great job of making it easy to connect to our platforms. But I do think that the environment and the climate for the industry right now being dominated by regulatory, responses makes it very challenging for people to deploy technology in a way that allows them to do better. Right. I think a lot of it is somewhat treading water. We're trying to respond to, things that are being thrown at us, and trying to make sure that we are compliant with all of the various regulatory regimes that are out there. And certainly looking at 10C1 is something that's upcoming, and that we'll have to yet again dedicate resource, both human and technological to address, right, becomes a challenge. I think that the tools are there. I think the legacy architecture, is kind of already mentioned, is a challenge for folks in terms of making sure that you can integrate. I would say that I bet people recognize that their technology stack is not optimized as it stands right now, but it can be a headache to think about how do you better build it, right? How do you take out what you already have there and dedicate resources towards putting in something that's optimized? But I can't think of anything more critical for folks to actually think about doing, right? Yes. As costs continue to rise from a trade processing and regulatory perspective because of inefficiency, you've got to have an efficient model that you're operating on, or you're going to be on the back foot the whole time, right? So you have to look at what is that best placed integrated ecosystem that I can be participating in as a trader, that will allow me to build scale for the future.
Yeah. Go ahead, Jay.
No. Please, Roy. Please go ahead.
Okay. I was going to say, because I think that classic run the bank versus change the bank issue is no different today than it was 10 years ago, 20 years ago, 50 years ago, for those of us that were around. Not even I was around 50 years. Well, I was around, but I wasn't in the business. But look, so I think that's the challenge. And what I see, based on what you guys or what I hear, is that although there's solutions out there, these things all cost money. We're coming from a number of years where revenues have been suboptimal, and we have a little bit of regulatory overhang still ahead of us, although a big chunk of it is now sort of behind us and being refined and hopefully reviewed. So I think the real question here is how do you actually even define what the gains are and where we're going to extract them? So maybe we can start, having identified some of the problems, let's move to where those gains can come from. And maybe Ed, I can ask you to sort of kick that off.
Yeah, sure. I'll stick with my area and talk about the technology. I think for me and for the business that I represent, it means about improving efficiency. So as I said at the beginning, one of the things that we do is our focus is on automation of workflows. How efficient we can be in relation to how optimal those workflows are, how we build the solutions that are designed to support those, how effective they are in terms of actually how our clients, use the systems that we build. That has a direct bearing on the level of automation and the freeing up of human capital to do things that are more interesting and less manual. I think those are the big gains. From a purely technology point of view, I think it depends on where clients sit, whether they're a new entrant, whether they're held back by legacy infrastructure, whether they're fully automated and plugged into all of the different flows and markets. It's a big spectrum of how sophisticated their needs are, and in terms of how advanced their capabilities are. If you're, as I said, if you're really highly automated, it's about being able to focus more on the high value stuff and automate most of the low the flow trading. But if you're, as I said, at the other end, it may be just because you're held back by your technology, or you're just starting out. It may just be simply digitizing some of that very manual work that's taking up a lot of the time. Removing the manual touch points, making sure that you've got accurate visibility on how your collateral is deployed. The implications of that from a balance sheet point of view. Those are really important things that you can make big gains in just by having better access to technology. I think it's been clear for a while. The general trend is, on the execution side of these businesses, it's much more advanced, and there's gains to be made and I'm sure that there'll be a panel talking about blockchain later, but gains to be made in the settlement processing areas, the life cycle management and so on. So I think that's probably where the biggest gain is to be made. But it's really just about being able to scale. That's, I think, is the greatest area for technology to help.
Yeah, like I think I might just jump in there, Roy, for a second. I think Ed makes a really interesting point, because certainly at WeMatch, from a workflow perspective, as I mentioned earlier on, it was transformative. But the rewards that we get are when a client calls us and say, "Hey guys, you guys have just saved us 3-4 hours a day in a manual task that we used to do," right? And that's a huge statement. And being able to build algorithms, being able to partner with the clients, being able to listen to what the feedback that they give us, and then build a technology to manage that effectiveness and effectively is the reward. And I think if I look at the workflow and lifecycle management events that take place in the market, even to this day, it's still spreadsheet to spreadsheet, email to email, voice to voice. This is 2022. We're securities lending and TRS and securities finance, perhaps being not at the forefront of equity floor management for many years. It now is, don't get me wrong, and prime businesses definitely are. But the technology is very old, and to Mike's earlier point, it's hard to unwind it, right? It's hard to unwind that architecture. However, you have to take that step forward, and you have to embrace change to make it more effective. And I think workflow management is the key. And for us, having those rewards and being able to build those algorithms, whether it's in TRS world where you're managing ESG, UCITS, ADV, specific clients, ETF optimization, all that criteria that's important for clients, is saving them money, time, but most effectively is saving them balance sheet.
With Shane, I'm interested in something. We've got a question from the audience here, but let me go to the question from the audience. So Shane, you had mentioned the idea of sort of new entrants, and there's a couple of different ways of new entrants. When I was thinking of new entrants, I was thinking less of vendors and more about new trading entities that in a lower cost operating environment would bring new trade ideas, right? And the analogy that I've given is when stock exchanges started computerizing in the 80s, they didn't envisage high frequency trading, but the fact that there was computerization of it and then decimalization of the currencies all of a sudden made it able for these new trading strategies. And I kind of see that kind of change. But the question from the audience is more on sort of the infrastructure providers, and rather than this kind of explosion of maybe new participants that go in, because there's new ones. WeMatch, as you said, for the last 5 years. There's others that have come in recently. Wouldn't it be better to have like sort of consolidation amongst existing providers to make things even more efficient, or do new entrants give people even more headaches because they got more choices now? And does it then become paralysis? So I'm interested from all of you on that kind of thoughts.
I'd say there's probably a bit of all of that, right? It's certainly more participants give you more to think about, but more participants drive competition. Competition, facilitates innovation, right? Things that people have to figure out ways to do things better, right? I mean, I'd say there's certainly an appetite for some level of interoperability. And it's something that we've explored previously, and we continue to talk to other firms from an Equilin perspective about, how can we work together to deliver a blended service offering that, that elevates above what each one of us could do individually. There's their own challenges in that, right? So how many clients are really interested in taking advantage of it versus use it as a buzzword? How to do it, right? What's the cost of doing that? Ultimately, I think that there needs to be some sort of common infrastructure in play, and there needs to be ways for systems to talk to other systems in order to create that efficient environment that we've kind of talked about previously. And then, I think, Roy, to your point around new participants, I think absolutely, right? If you can reduce the cost of trade low enough to enable people to take advantage in greater scale of something like peer-to-peer or direct lending, or just enter into a market where they were going through an intermediary previously, there's going to be new ideas and new thoughts and new strategies that come about as a result of it.
Yeah, and to add to that, I 100% agree with you, Mike. And I, we Rematch are very much in dialogue with other participants in the marketplace on that exact point from an interoperability perspective, both from obviously we're highly a front office function, but also within post trade partners. I think what's really interesting, though, to your point about innovation, and new trade ideas, it's remarkable to think in this day and age that when a hedge fund wants to short 10,000 shares of Air France and he calls his coverage guy at a desk, the desk has to turn around to a supply guy who then has to pick up the phone and call a beneficial owner, or call a lender who then calls a beneficial owner to get liquidity and come back to the marketplace. If you go to the equity market to trade 10,000 of Air France, you get it done in less than a nanosecond, right? And in stock loan, it takes close to 35 minutes. That's just, in my opinion, totally inefficient. It's ridiculous. So at WeMatch, what we've built is to bring innovation, to bring that concept of time, bringing liquidity, bringing trade ideas, bringing a concept from the equity market to the securities lend market, dark and lit liquidity, IOIs, RFQs, to allow clients to trade that hard to borrow segment of the market, which in my opinion is inefficient dramatically to this day, and try and create that place of liquidity, create that marketplace. So bringing not a trade idea, Roy, to your point, but bringing a concept to make trading more effectively for the market.
Roy.
I wanted to turn to you, Travis, because you're really on the sharp end here with customers and sort of in various different guises and seeing different kinds of trends. So I'm really interested to hear what you have to say on this.
Yeah, I was going to say, I was going to kind of boil it up a little bit, but, you mentioned the either run or change the bank, the last 50 years kind of theme, right? And the difference, I think, is really since 2013 or 14, my view, but the numbers will prove it, is this fintech boom has really, and there's, whether your fintechs are, leveraging technology as all the great providers we have on this panel here, it makes it a lot easier to go and transform the bank when you can either partner or buy a service that will really open up your capabilities. And that's one thing we've noticed, is that we're able to actually focus on rewiring, taking the cables out and, making things wireless, or, per se, as the analogy, while we leverage the best in breed of all these fintechs who, going back to the original question, is you need more, but you also need less at the same time, because we're not there yet. We can't keep up with technology. There's blockchain, there's DLT, there's all these great ways to digitize your services, and we're not there yet, but people are trying, and it's a great market to get good valuations, to get investment, to go and try to do this, and then partner with these larger institutions to really get this nice complementary program. And so that's the way we think about it. And I think it's a different age that we can really accelerate with, using these types of providers on the phone, on the call right here.
Yeah, and Travis, look, I think that's one of the interesting things, and this is all public, but you guys, for different elements of your different sort of new product releases, or whatever you want to call them, you've actually partnered up with other people. It's not been, well, we've got a solution internal and we'll create one, and if we need one, we'll do that. It's been a much more sort of agile approach of saying, well, this is the problem we're trying to solve, and how do we do that? Can we do that, or do we need help with that? So if you can maybe just add a little bit more to that, is maybe what the thought process is, or how.
Yeah, and it goes back. Go ahead.
No, go ahead, Travis.
No, I'll come back. I'll come back to you, Mike, after that.
It goes back to maybe my comment earlier around, minimizing providers or the best in breed and ultimately building an ecosystem, right? We are a custody bank. We have settlement mechanisms. We are collateral managers. We can do all this. We can provide transparency from the depths of custody up and, leveraging these great technologies. And when you do that, then you create flexibility. And then when you partner with these technology firms that are, taking it to the next generation in securities finance, that's when you open up the avenues of peer-to-peer trading. That's when you can get flexibility down to the trade level on whether you want to be an indemnified or unindemnified trade, whether you blur the lines between a lending trade or a repo, for example, or a swap, because it all, you have that customization and that flexibility where you don't have to go rejig the whole workflow. You can fix it at one point because it's normalized and it's customized at the same time to meet your demand. And so that's what we're trying to do here. We're trying to create value to our clients, to the buy side, by providing alternate avenues, leveraging all this great technology that's still kind of turning and burning to get where we want to be. So that's what we're excited about. And that's why peer-to-peer, and that's how you really open up the gates to peer-to-peer, is making it easy on the buy side, because they aren't positioned. When the value is in the trade, but then it gets to the depths of supporting that trade that really open up the channel, from our perspective, at least.
Thanks, Travis. Mike, did you want to?
Yeah, I was just going to add that from a technology provider perspective, again, I think we have to be efficient, right? So in terms of deciding when we want to build a new product or where it makes best sense to partner or work with someone else to offer some sort of JV, it's about identifying who's already got sort of best in breed for whatever problem you're trying to solve, right? From an Equilin perspective, we do messaging very well, right? We route things to people. We enable that straight through processing. We reckon we've got 50+% of all securities lending transactions automated across NGT at this point. We offer swaps and we offer a cleared solution, but from some of the more sophisticated processing problems, right? We've decided to work with Spire, right? So it's how do you create that ecosystem? How do we decide where best to build new versus where to partner with old, and how to create that interoperability that really is the driving decision point for us as we look to how do we continue to innovate and push forward.
Yeah, thanks. Listen, we've got another fantastic question. If I was in the audience, this is the question I'd be asking. So obviously, whoever sent that in, very well done. What does the group see as being the key to instigating the paradigm shift that is needed to move away from spreadsheets and the telephones? A raft of tech providers exist already. So where will the impetus come from the mindset change, right? So, and again, I think this kind of encapsulates, I was talking to someone about this last night, when I was doing some investigations into mismatches on contracts, I would talk to a number of back offices in various places around the world, and they said, yeah, well, my job is when I get the 100 breaks is to allocate those breaks. And once those breaks are allocated, my job's done. So that's a 100% solution. But obviously, without doing a root cause analysis, you aren't going to change anything. You're going to have 100 tomorrow. But that person's job and the person they've given it to, those things all work in conjunction. So it's about that. What makes that change? You guys have talked, Shane, you've talked about people innovating, coming to the platform and re-looking at their processes. But I think the challenges I'm hearing from everyone else is we've got ingrained, embedded processes that need to change. So what is going to turn that key?
It's happening. It's happened. We, with our customer base and our partners, for example, we have close to 150 billion on our portfolio on WeMatch to date from a TRS perspective. It's from an EMEA standpoint, and what that means is that people are using our platform for lifecycle management and optimization events. So, as I said earlier on, historically people are sending a spreadsheet with a list of 100 stocks to counterparty A, B, or C. That counterparty is then reading that, digesting it, and then sending it back to them saying, I can't accept these individual names. And it's this constant back and forth process. And what WeMatch has the ability to do is effectively do that in an algorithm and automated fashion. So the impetus, if I'm sitting on a desk as a trader and I'm sitting there doing that manual process before versus having a fintech company come in and do it for me in a better format, and from a community perspective, which is the most important point, having the ability to have all your partners on the same platform and digesting that information, it just creates that impetus to make that effective change, to move the technology. I think if you look at, and again, I'm going to speak a little bit controversial here, right? I'm of a tenured age, Roy, not quite as old and as beautiful as you, but I am of a tenured age, which means that when I was on the desk and I was setting in my guys, and they've been sitting there for 10 or 15 years, I'm very used to the process. I'm very used to getting the spreadsheet and sending it to the spreadsheet. You go now to, millennials are probably even past that, but Generation Z, they don't want to do spreadsheet to spreadsheet. And I think that the community that we're dealing with on a day-to-day basis want that change. They are the new breed coming forward, and they're the people that are actually demanding the change. And from a managerial perspective, we talked about effectiveness, efficiency, and balance sheet throughout this call. If you don't do that well, and with the post-trade stuff, as absolutely right, as you say, you're not going to run a successful business. So you in my mind, the impetus to make the change, and which I see and we see is currently happening, it's about the dynamic ability to take away some of the functionality that was taking a huge amount of time and pressure before away from the trader, to allow that trader to do more effective things in pricing new trades. And to your last point, right, coming up with new trade ideas. And that's the impetus, in my opinion.
But I think there's a disincentive to take on additional risk in changing process and changing behavior, right? So people, especially in post-trade, right, the best thing that you can do is not mess something up, right? I started in operations years ago, and so I'm familiar with a little bit of that, right? In terms of spreadsheets, it may be a suboptimal process, but you're comfortable with it. It's been blessed by compliance. It's been blessed by audit. So there is great comfort in the fact that it's understood, and it's sort of not well managed, but managed in a way that is comfortable to everyone. So when you start to try to change behavior, changing that behavior and getting their commitment to get buy-in from all of the requisite parties that are required to kind of improve can be challenging. So you really do have to be very clear that you understand the problems, you understand the inefficiencies of the process that are in place today. And when you put it back together as this new, better process that has automation embedded within it, and that there is sort of AI or computer logic driven behind it, that it's going to make it better, right? And you do have to demonstrate that. And I think that helps a lot.
Yeah, I think, look, sorry, go ahead, Roy. No, go ahead, Roy. No, please go ahead.
I was going to actually talk to Travis, because I'm interested in your thoughts there, because obviously what Shane's talking about makes quite a lot of sense in terms of innovating and try to do things in more efficient ways. And so the different mindset of the individuals that are involved in that. But I also really, what Mike said really resonates with me, right? I would tell you, people are more afraid of getting it wrong than celebrating getting it right, and changing things. And that, and some of that's, incentives, which have changed partly because of regulatory purposes. But again, on the sharp end at a provider there to multiple market participants, Travis, what does this all mean at you guys on your end?
I think I think we're really fortunate that we have the ability to have a bit of a long leash to try some new things and accept that failure is okay at times. Now you got to balance that, right? Because we have, you take risks and you have to manage your shareholder and client demands, and we're all resource constrained at the end of the day. But trying that with a broad audience of, and this is a little bit of a cop out, but I also think there's a lot of a generational pull with, the root in that spreadsheet question, right? I think people going to spreadsheets was a generational change. People moving off of spreadsheets. Why are you copying and pasting into something that you really don't need to do, or centralize your data in something that really is right there in front of you? There's a lot of habitual, past that you can, bring it forward. Why can't you negotiate a trade just over an electronic platform? Why can't you digitize a contract? But you have to see it and sign it and scan it and fax it, and and it's a mindset more than anything, because there's a lot of efficiency there that the human brain just needs to get over.
I 100% agree with you, Travis. But I think I'm very passionate about this point because I think it's essential for the industry to move forward. And if I think about equity business and cash trading, they've done it, right? They've moved that generational gap, right? And securities lending, TRS, and repo still is in the dark ages. Right. And that, I understand your comment, Roy, but with humbly, and I obviously worked for you for many years, I totally disagree with it. We have to move this business forward. We have to get away from that mindset of, I'm scared of changing something because I'm going to get in trouble. I mean, you can't have that mindset in this day and age. And
Shane,
you can't, but you do, Shane. So I think it's on us, right? So it's on us to change. Make sure that we're demonstrating we understand how to fix this, right? And I think we're seeing it. I agree with you in that we are seeing it, right? We see. I mean, if we look at our post-trade platform, we can see the utilization of our core returns processing, some of the interest in our international recalls product, which no one wanted to touch for a long time because it might make me easier to recall, right? So there's all of these objections that get put in place. And then, once people adopt the new processes, you could see that it was just so much, it was nonsense, right? It's just a garbage objection to kind of keep my control over the process that I was running with. But you don't have that luxury anymore, right? Again, we can mention cost, we can mention, regulatory. So if you look at CSDR, we've seen tremendous growth off the back of CSDR because analog processes resulting in sort of data entry. I mean, it's a ridiculous process to have in place, and migrating something to digital doesn't necessarily replace a person, but it takes out that sort of human element of risk that was incumbent in the old process. Yeah. So it's not a threat, right? This is a complement to the smart people that you've already employed, and smart people figure out ways to use tools to do things better, right? Yeah, that's what smart people do.
And I think that the standard. Sorry, Roy. I think that the standard.
Yeah. And this is the last comment.
The standardization of the product is important, right? Because we're CDM is a good example, which is are obviously running at the forefront. It's a great idea, right? They've done it for ISDA, and ISDA is trying to bring some commonality to this industry and to this specific segment of the industry. And I think standardization is really important from that standpoint. So I agree with your comments, and even from your business at Equilend, you've transformed what you've done over the years, and you've listened to the market and you've adapted. But I think we can't live in the dark ages and be fearful of repercussion. You think about the other industries in the world that have adapted to dynamic change, whether it's Uber, Airbnb, these type of companies. I think that the securities finance space and the capital markets in general need this transformation. Sorry, Roy.
Sure. All right. Yeah, no, look, and don't mix up my observation of how people act in the market with agreeing that it's a good idea, right? There hasn't been any sort of transformational change that I've ever seen that hasn't come with huge pain and additional cost. And then in hindsight, people said, yeah, but we couldn't get here without going through that. So, and I think that's really the point. Listen, we have another fantastic question from the audience, which I want to go to, and then we'll go to sort of the wrap up. The question is, in your opinion, with technology helping different market participants access the market, will agent lender prime brokers see a reduction of inventory on their side in the future? Right. So as you get more efficient, I guess to phrase it, as you get more efficient, technology, process optimization, do you really need as much inventory when there's so much out there already and you can just manage it more effectively?
I think I was going to jump in. I mean, I think it's, I think it's how you approach it, right? If you're harvesting the gains of the past agent lender model, for example, you're going to miss out in the next, 5 or 10 years on ways to create product that maybe, the avenues for peer-to-peer, the avenues for unindemnified trading is because there is a constraint on balance sheets, period. So if there's a demand for it, there's got to be some level of supply out there or better returns or optimized trading that could be achieved. And so if you embrace it, if you think about, maybe you don't make the balance sheet return, but you're offering the technology or the services you can provide to outsource trading, for example, but do it unindemnified or peer-to-peer or whatever. Those are ways to create revenue, not off the balance sheet, that creates new access to supply. And so that's kind of how we think about it.
Right. Okay, listen, we have one one more question from the audience, which I'm not necessarily going to ask anyone to answer, but I think I'll sum it up. Is that isn't the huge cost of internal IT and the risk of failure not an obstacle to move to a full STP solution? I guess what I've heard you guys say, and tell me if I summarize this incorrectly, is you guys are saying, look, yeah, sure, there's challenges in there. There's change, there's process, there might be investment in technology. There's certainly a change of human mindset required. But look, if you plan on being in the business 3 years, 5 years, 10 years from now, you kind of have to suck it up and get with the program, get modern, be an attractive counterparty. Otherwise, you'll be left behind. And anyone disagree with that or want to add to that before we wrap up?
Yeah, and I think just on top of that, you don't have to get to 100% STP, right? There are some things that are going to be more difficult to automate than others, right? So focus on the low-hanging fruit, and then come up with processes that complement human decision making with robust analytics and kind of automated data entry, right? You can make the decision on screen, but then it should flow automatically into your system, and you don't have the manual rekeys.
Good stuff. Thanks for that. I'm now going to move to closing. I gave everyone the opportunity to have 1 minute to talk about anything they wanted on liquidity and trading. That will take us to 2 minutes over. So I'm going to ask you guys to do it in 40 seconds. So give us an idea, thought, something on liquidity and trading. And Ed, we haven't heard from you for a minute. So over to you to kick it off.
Okay, so I guess my general takeaway from this, and it chimes, I think, with a lot of what everyone else has been saying in the last couple of answers, is that people shouldn't be afraid of the technology or the change that it inevitably brings. The pace of change, the advances in tech, whether that's machine learning, data analytics, those improvements, the possibilities that they provide are going to fundamentally transform the way that people spend their time in work. I mean, you can talk about the big picture stuff, but specifically in this industry, I think it's a fundamental change in the way that people are going to be doing things. And that's positive. It shouldn't be seen as a threat. It's an inevitable consequence of advancement, and it's a good thing.
Thanks, Ed. Travis, to you.
Yeah, I was going to just encourage, the audience, the buy side, the participants to have an open mind and to challenge and, try to give some time to, really test their own needs against, what could be provided for them, to give them a second, because I think there's a lot of value out there and a lot of people willing to make something work. I think about sponsored repo and how that has just kind of boomed over the last, 6 or 7 years, all because we've had great buy side participation and the right, folks come together to create a $300 to $400 billion marketplace. So those are the types of things people need. The open mind is similar to what the last comment kind of said.
Thanks, Travis. Mike, over to you.
Yeah, on top of all of that, right? Look at your processes front to back, pre-trade all the way through kind of post-trade and termination when you're evaluating how well your technology is deployed, how well it complements your human capital. Make sure you're connected to as many venues to execute as many trade types as you can. Keep that variability open, and just look to give yourself as many choices to optimize your process as you can.
Right. Thanks for that. And Shane, we haven't heard the word we match for a couple of minutes yet, so I'm sure you'll manage to slip
I won't say
comment.
To the closing comment, Roy, but no, firstly, thank you, Roy, for hosting a great session, and thank you to all the other panelists. It was a great debate discussion, and thank you to Securities Finance Times. I think my last comment would be, this business is going through a series of changes. I think to Ed, Travis's and Mike's point that we want to be open-minded in how we access liquidity, how we trade liquidity, how we manage balance sheet, how we manage effectiveness and post-trade. And, as I say to people that work at WeMatch, join the revolution, and perhaps for the audience here, perhaps not join the revolution, but join the evolution of the industry, and please be part of it. And that's it.
Right. Thanks very much. Look, I'll just add my thanks to panelists. Great job, guys, and some fancy dancing there. And now I turn it over to, so thank you to Securities Finance Times and all the sponsors and everyone that paid for this. And I will now turn it over to